we have Feroze Azeez joining us on Morning Brief at night this morning. Feroze, good morning. Thank you so much for taking the time. Help us understand what seems to be slowing down markets and the momentum in growth this morning.
Good morning, Kartik. Like you rightly pointed out, some of these big names, heavyweights, are down. That's why there's some degree of pressure. Like you see, over the last couple of days, especially the Monday, we had one of the largest moves in Nifty. Post that, there was Tuesday, which was a little lackluster. There was about 300 points down on Nifty. One thing which is very, very keenly something an investor or a trader should observe is the 300-point fall. The maximum kinds of short built-up happened in that 300 points. So 50% was the short and long ratio for FII's index futures. Just in 300 points of fall on Tuesday, the short positions went up from 50% to 63%. What am I trying to get to is this fall of Tuesday was driven by derivative, not by cash market selling, which implies the Wednesday's move being stable. What I'm trying to get to is there is a lot of derivative activity which has kept market subdued, not the cash market activity. I would presume that's what is happening today morning as well.
All right, Feroze. I want to now come to you specifically about the MSCI rejig, Feroze, and there's news that Murugappa Group's Coromandel International Limited as well as FSN E-commerce Venture parent company of fashion and beauty retailer Nykaa will be included in the MSCI India Index, which is part of the MSCI Global Standard Index by the end of this month. However, there were expectations that Paytm, One97 Communications, the parent company of Paytm, will be included, but that has not made it to the MSCI Index. Now, analysts had predicted that the stock could return to the MSCI Index after it dropped last year. So, number one, what does the MSCI Index really mean and why does this rejig happen? And number two, what does this mean for these three stocks specifically, Nykaa as well as Paytm and also the Coromandel International Limited?
Kartik, if you look at MSCI does a rejig every 3 months. 14th February, starting from Valentine's Day, you can keep adding 3 months, May 14th, and so on August 14th, November 14th. These are the rejig announcement dates. The applicability of rejig is on the same month ends. That's point one. Point two, MSCI has several indices. Morgan Stanley runs an index service, which is one of the most popular in the world. For global players, this is as good as Bible in terms of investing, index fund investment. India has two relevant indices. One is the India Index, like you rightly pointed out. There's also the MSCI India Small Cap Index. The last time I checked, the MSCI Small Cap Index had 467 stocks. The Indian investor, Indian fund manager, tracks only 250 Indian small cap stocks in the NSE Small Cap 250. And ironically, the foreigner sitting somewhere globally has 467 stocks in the index. So coming back to your point, that MSCI India Index is a very important index, point one. Point two, the predictability of that is out in the open. So people already, there are about 8-10 FIIs who already play this theme to preempt what is going to be the change on May 14th, and they build positions.
All right.
So trying to capitalize this move from a short-term perspective for an individual trader is a bad idea, because there are algorithms which predict what is the change, what is the percentage change, what is the demand which will come or supply which will come, and position themselves to take benefit. That's why you see on the May 31st or the last day of this month, you will see the last half an hour, the volumes of these stocks will be enormous. This, if you observe and you go back in history and observe all these announcements, you will see last half an hour volume will be equal to 15 days volume, because a lot of foreigners build that position and hand it over to the index funds in the last half an hour of trade on those dates. So, but it's a very important and a topic for an elaborate discussion at a point in time. So answer your pointed question, don't try and play this theme because FIIs would have already built, short-term FIIs would have built positions, taking benefit of this already.
All right. And for a one-year scenario, what does this mean specifically for stocks that do get added to the MSCI index and those that do not? So, for example, since Paytm was dropped last year and Paytm is not being added this year, there's expected to be little change for Paytm. But what does it mean for, let's say, over the next one-year horizon for stocks of Nykaa, for example?
Yes, see, I personally think that FIIs who follow an index fund investing are the most stable investors, not even Indian mutual fund investors. They follow MSCI. So I would say a complete free float washout from the market is what you see in these stocks. So Nykaa, if the X amount is the free float, you can work backwards and find out how much index fund investing is being done in MSCI India Index, and you will be able to calibrate and figure out what is the portion of free float will be absorbed by these FIIs, and that will go out of the market for good. So to answer your pointed question, Kartik, it's a very, very good news for these stocks. But getting threadbare and understanding what free float will be absorbed by them, and the weightage is where the devil is lying in the detail in terms of weightage. I have not analyzed the weightages. Probably we can subsequently do it in a couple of days. And I'll try and understand what kind of free float will get absorbed by this new weightage, the MSCI India Index.
Right. But typically for retail investors holding these particular stocks, and let's just talk about these three stocks that we are flashing on your screens right now, what does it mean for those retail investors? Inclusion in MSCI means there is a higher chance of the volume of trading growing, and hence should they hold on to these stocks? Is it good news that these stocks have been included? And thereby Paytm not being included, what does that mean for retail investors holding the Paytm stock?
Kartik, I can't comment on the specific stock, but I can definitely tell you if I was holding any of these stocks, they get included. I would consider this as one of the best news for the stability of the stock.
All right.
Will it result in what kind of price rise? Again, depends on the results and the business and the current shareholding pattern.
Right.
But is it a great news? One of the best news you can get in terms of the stability of the stock, if not the move. And if it's not getting included, that's a very bad news.
All right. Well, perfect. Thank you so much, Feroze, for putting that in context, because these headlines make the news every day. MSCI inclusion, MSCI exclusion, not making it, missing it. I think it's important that you've broken it down for the shareholders who are holding these stocks right now. And of course, we'll not pin you to specific stock details. But I want to now shift focus to another sector that we are tracking, Feroze, and this comes by way of defense stocks. And defense stocks, remember, have added as much as 1.2 lakh crore rupees to their market capitalization in 12 trading sessions. Stocks like Hindustan Aeronautics and Bharat Electronics have seen the largest addition in market capitalization terms, while stocks of Garden Reach has been the biggest gainer in percentage terms. I want to understand from you, Feroze, we saw Operation Sindoor, we saw the hostilities from Pakistan and India's retaliation, and some of the homegrown defense equipment auguring really well for the battle that ensued. So specifically defense stocks, that has been a theme which has been fairly volatile all of last year, but it seems that Operation Sindoor has given some sort of a fillip to defense stocks. How should investors view defense stocks from here on?
Yes, Kartik, how would I look at it? Not that I recommend such high beta stocks. From a long-term investing standpoint, it's not that they will not make money. It is that you will not be able to see the light at the end of the tunnel because it's high emotion trade. The problem is not whether the stock will make money in 5 years, 10 years. Will you be able to hold it with this kind of high beta? Most people sell it. If it doubled, people sell it. But if it halved, they hold on for 10 years, waiting for their price to come up. That's what kills the IRR of a direct equity portfolio. Coming back to your point, like you have rightly observed, these are very high beta. So if I was calculating these defense stocks which you listed on an index basis, the beta is almost about 2.4 times that of Nifty. That means they take 140% more risk than Nifty. That's one of the highest beta stocks. So if you have a high beta trade, you should always take it at the trough. And I think that trough was clearly established about 3-4 months back when there were no takers for defensive stocks. HDFC launched its defense sector fund. That was one of the best timing. I would give credits to the second largest AMC to launch it at the right time, make the right amount of money. So to answer your pointed question, if you take high beta, you need to have steel nerves, point one. If you take high beta, you have to have the courage to buy it at trough. But if you want to take high beta, also look at a mutual fund rather than a direct equity. That will be my take on defense. And I think it is run little ahead because of sentiment. I would say that it has already given the next 1 year return in the last 5, 7, 8 days. And I think it will taper down. And from here on, making 4-5% alpha on Nifty will be a little difficult task for these stocks.
All right. Well, that's the very, very pointed, sharp view coming in from Feroze Azeez that perhaps they have already delivered what they had to, and there could be some correction in coming times. But Feroze, there's a barrage of data which is coming in, not just from India, but also from the US, but specifically on India. Inflation numbers have come out really well. Even WPI inflation data that came out yesterday, the April inflation on WPI terms at just 0.85%. Pretty clear-cut signal that RBI is going to go ahead, cut interest rates next month, and not just in the June monetary policy, but as trends suggest right now, at least going forward, we can expect at least a 75 basis point or so cut in repo rate by the RBI. Now, what does all of this mean for the economy, and what do these data points suggest as far as India's stock markets are concerned? Because we are still a large distance away from where we were on the 26th of September last year, when Sensex and Nifty were at record highs. So with all this data coming in, more money technically in the hands of consumers, what do you make of, let's say, the next 6 months or so for Indian markets?
Kartik, like you rightly said, inflation has come at a very, very good number. What's heartening to see is there has been a lot of consumption boost from tax reductions. Economic activity has been good, is why you see the highest GST collections in April. You see a 13.7% growth for the last financial year in direct tax collection. In spite of all that, inflation tapering down is a very, very good news. Sometimes what happens is if there's a lot of money in the hands of people, inflation gets pushed up. Of course, CPI is more of food and travel and transport, but still there is always an upward push when you put a lot of money in the hands of a person. There is a blip in terms of inflation up move with a lag of 3-4 months. That didn't happen, which is a great news. Second, inflation has a correlation to everything practically. Like you rightly pointed out, repo could come down. If repo came down, it'll impact the debt markets. In fact, it'll impact the equity markets more than the debt markets because the repo rate is significantly close to the 10-year G-Sec. Anytime a country which has operated in a yield curve which is upward sloping suddenly has a flat yield curve, people don't know what to do. If my dad went to a bank last year, he gets the same rate for a 1-year FD and a 5-year FD. He says, this is not what I'm used to. Give me a 2% more for an FD, which is 5 years. So he's always doing a 1-year FD instead of a 5-year FD. That is making banks' deposit rate becoming so much difficult, because every year you have to go to my dad and get a new fixed deposit, which is so much difficult. Once repo comes down, the differential between 1-year FD rates and 5-year FD rates will be apparent to naked eye. So the senior citizens of India who fund the NIM of the country's banking system will be happy to do a 3, 4, 5-year FD rather than a 1-year FD rollover. So repo rate will have a huge impact on the deposit growth of the banking system, one, and 27% of Nifty is banks. So will it give stability to Nifty? So will it give a push to back to 26,213, which is where it was on 25th of last year, September. I think we are just about 1,500 points away, 800 points, 1,700 points, 1,500 points, which is 7-8%. I think this financial year, you should see Nifty back to those levels and a little more, given the kind of conducive raw material we have in the economy.
All right, so that is good news for those who are following the index. But Feroze, you did mention the impact of a repo rate cut on the banking sector, but I also want to draw your attention to the auto sector. And loans getting cheaper is likely to be good news for the auto sector. But auto stocks have been fairly volatile, given that, of course, at one point there are Tata Motors, which has slipped, of course, significantly from its peak. But in addition to that, the entire debate around auto components and their exports to the US, given what Trump has been saying and doing on tariffs, is something which has kept auto stocks also a little on the edge. What is your view for auto stocks specifically, over, let's say, the next 6 months to 1-year horizon, given the volatility in Trump and the fact that we may see rate cuts coming soon?
Yes, Kartik, I think auto is a very, very tricky space today. I was looking at the trade agreement with the UK. Today, to import a car from the UK, it's 100% tariff, 100%. Let me repeat it.
Yeah.
Of course, UK does not produce too many brands of cars. They produce high-end brands like Bentleys and the Rolls-Royce.
And the Rolls-Royce and the Jaguars and the Land Rovers that Tata Motors owns.
Correct. And if that is going to be brought down to 10%, now that's going to be a level playing field. There was a lot of shield to the Indian auto industry, a big shield, right? So a 4 crore Rolls-Royce in the UK is available at 10.5 crores in India. With all the taxes, almost in the luxury segment, it goes to 180%. So will the auto sector get some stiff competition? The answer is yes. And I would stay away from it till this structural change, which can change the way auto industry in India has operated. Till that goes through, I would be circumspect jumping the gun. I'm not saying there's no more money to be made. Of course, there is some degree of that sentiment already priced in. You can make money, but I don't like to gamble. So I would stay away from it.
All right. Feroze Azeez not gambling there on auto stocks, and his recommendation neither should be. Feroze Azeez, always a pleasure having you right here on Newsline. Thank you so much for your time.